Ted Oakley, managing partner and founder of Oxbow Advisors. It is so great to see you again, and it is so wonderful to welcome you back to the show. Great to see you as always, Ted. We always love having you on this program.
Well, thanks, Julia. You know, as I always said, I admire the fact that you've been doing so well with your channel, and my hat's off to you.
Well, you are very kind, and I appreciate that. And you were actually the first guest that I did an in-person episode. And so ever since, we've been doing more of those, and we'll have to get you in studio at some point. If you're ever in New York City, let us know, because we have an amazing studio there. Or maybe I'll have to do an Austin episode again. But if I look back, that was one of my favorite ones. So you're always a treat to have on.
Yeah, we're in New York 4 or 5 times a year, but I didn't know you had a studio there.
We do. So our producer, Matt Merlinski, has an amazing space, and we've had Danielle T. Martino Booth in there, Josh Brown, and many others. But we would love to welcome you in at some point. So definitely let us know when you're in the city, and we'll make that happen. And gosh, all right. So we are recording on Friday, January 17th. This episode is going to air on the morning of Tuesday, January 21. So this is the last conversation we're having before the inauguration happening on Monday, January 20th. So I'm just giving some context for the folks watching and listening as well as to when we film this. And let's start, Ted, where we always start, because I haven't had you on in several months now. We're into 2025, new administration taking shape. More of that big picture, macro view, where we are today as it relates to the economy, markets. We can do a little bit of a retrospective as well, and then kind of more future forward looking, how you're thinking about things. So as you know, Ted, the table is, you can take all the time you need to set the table. The floor is all yours.
Well, thanks, Julia. You know, I'm probably much better at the micro and stock picking from the bottom than I am the macro. But I would say this: I think the biggest thing that investors will have to grapple with this year is this coming head-on collision between government debt and the interest rate level. And I can't say that we know how that's going to come out, and nobody does, but that's the problem. And if you take the new administration coming in, a lot of things they want to do, I think, are admirable. But the problem is, if you do a lot of those things at the same time with a strong dollar, debt where it is, and rates where they are, you could conceivably really mess up the bond market, which would mess up the stock market. So I think you're going to have to be a little cautious as they come in, because they're going to float all of these things probably in the first 2 or 3 or 4 weeks, float some trial balloons and that kind of thing. And we'll have a little better feel for it. We haven't been able, you know, we buy stocks from the bottom up. We have screens for those, and people don't realize, but really the Mag 7, the big 10 companies that are in the S&P, they all peaked the first week of December. Mm-hmm. They're not at a new high right now. They've all rolled over. You'll see them come back on days like today, but generally they've rolled over from their peaks in early December. Will that be the high? I don't know. I do know this: they're still fairly expensive. And for us, we look at companies separately, single by themselves. Same way with bonds. So if we see something we like, we'll buy it no matter what the atmosphere. But right now, we just don't have that many companies. But I think the macro will be a little confusing, because people don't understand what's coming on here with these rates where they are and what's going on with the U.S. government right now.
Well, to that point of folks not understanding what's going on, you know, as it relates to rates and our debt situation. I'm just looking right now, pulled up the U.S. debt clock, which I do often on the show, 36.36 trillion, and it's ticking higher. And of course, the interest on that debt being north of $1 trillion. And I know there's also the off-balance sheet as well, that whole issue. But you mentioned like a lot of folks not being quite aware of this dynamic. And to be honest, Ted, I'm definitely not an expert, and I'm still trying to wrap my head around it too. If you don't mind, could we just put a little bit more meat on the bones, you know, kind of bring this audience up to speed, like what is going on here and why this matters? Like, why is it, and how is it that the bond market could mess up the stock market? I just feel like I'm hearing about it. I want to hear more though.
Well, Julia, there's 2 facets to it. One is, if you have a strong dollar, which we've had and continue to have a strong dollar, and then you go into all the countries and put on blanket tariffs, for example. I don't know that they're going to do that. I'm just saying what they mentioned they would do. Then all of a sudden, those two items alone are automatic inflation. That's one side of the equation. The other side right now is the U.S. government has to refinance about 10 trillion just this year, maybe 11. And they have a $7 trillion budget from the continuing resolution, but we've got a shortfall of 1.8 trillion. Now, if they're able, they were talking about maybe reducing that by 2 trillion. But if you think about it, if you take 2 trillion out of the cost side, okay, not the revenue side, you probably are going to be close to recession, if not automatically in one. If they do 1 trillion, you're still going to have I think you figure about for every $1 trillion, it's about 2.5 points of GDP. So here's what happened. Here's the struggle. They need to refinance the government, plus they need to do new debt all the time. The new treasurer will have to decide, unlike Janet Yellen, who kept everything really short in T-bills, if they're going to get their finances straight, they're going to have to lock in some longer paper that's like 20, 25, 30 years. And the reason they have to do that is because if you keep having all of this money come due that they kept short term, then you're going to be a prisoner of a rise in rates. And it doesn't work in the government side. I don't know how they will address all of that, but I think people need to understand they need to watch a couple of things. Watch the dollar if it stays strong and doesn't weaken. If you put that together with how much debt that has to refinance, and the fact that if you just take the receipts for taxes right now, you just take the receipts and a little bit of the debt that comes due, use all of that just from the interest.
Wow.
And so we don't have any room here to move, and what happens. And I think people, if you look at the 4 things they want to do, which would be lower the corporate income tax, take personal taxes back like they were, don't tax Social Security, and go back with a couple of other things. That alone right there, if you don't change anything, that increases your budget deficit by about 30%. Now, I'm not saying it's a great. It's admirable to try to get these things efficient, but it's probably some pain in the short run for gain in the long run, and that's all I think people need to understand.
Mm-hmm.
With Ronald Reagan, by the way, lots of pain. He came in January of '81. We had a bear market, lasted all the way to August of 1982.
So pain in the short term, you would have to do pain in the short term for gain in the long term then here. I've heard that theme before. It makes you wonder too, though, Ted. I mean, it's kind of an interesting dynamic because we have a president who's been president before coming back into office with a 4-year gap, like a 2.0 here. I mean, I wonder if maybe you could do that because you're not running for re-election. You don't really have, I don't know. Maybe that's a bad question, but.
Well, I think it's a good question. I mean, obviously you're correct. He can't run again. So he's going to do whatever he wants to do this time. I mean, within the realm of getting it approved in Congress. I think people don't realize it's pretty skinny Congress. I mean,
yeah, it is.
We on the House and the Senate when that goes. But, I will say this, or at least it looks like to us that they had a pretty good feel for it, haven't been there before. So they put people in that are going to really react quickly.
Mm-hmm.
All I'm saying to that is sometimes those reactions, which are good in the long run, they can cause you some pain and maybe cause some pain into the stock market, or cause some pain in the bond market where rates in the bond market say, hey, you know what you're doing right now is not correct. In other words, you don't have the priorities in line. You'd rather have a lower dollar, not really be pushing the inflation tag with so many tariffs. But we'll see what happens. I'd be the first to tell you it's a guess. I don't know. We just have to manage.
Well, that's the thing. No one really knows, and a lot of these are just probabilities. But I still love just having these conversations and trying to understand what are the probabilities, what are the scenarios, how would you think about it? Let me go back to something you said about the Treasury. You mentioned that Janet Yellen did a lot of stuff with the short term, and kind of more was a prisoner of the rising rates. But you mentioned that Scott Bessent, the new Treasury Secretary, is going to have to lock in that longer paper, like the 20 and 30 year paper. is that going to be challenging? Like, what is even the appetite for, these kind of longer dated treasuries? I'm not too familiar, but what's the appetite for that? Or can you explain more of the dynamic there? If he's going to have to lock in longer paper, what that would mean?
That's a good point. If you look overseas, they're not buying any more bonds. And you have to think about this. They're at the same level they were, 12 years ago, as far as the bonds they own. They don't buy any new ones particularly. They buy a few to keep, some of them countries do. But on the other hand, a lot of those countries have dollar denominated debt. So if they get in a situation where the dollar keeps on getting stronger and stronger and we don't pull that dollar back, that means that, think about it, that means they're having to pay more with their currency on that debt because they're converting to dollars. And that's a negative for everybody if they can't change that. But the second part of it is that we have a situation where that we're at a point to where debt is really constraining. It wasn't like, when he came in 2016, we had a lot less debt to GDP than we do now. Where government debt to GDP is 120% or so. You get to that level, you don't have a lot of, there's not a lot of moves you can make. So you've got to do some things that will, like I say, would be good for you. It'd be like going to the dentist, and you're gonna get a shot, and something's gonna happen to you, but in the long run, it's good. It's something like that. I think people just wake up. This is not a time, to me, to be starting some brand new, investment program when things are probably as up in the air right now as they've ever been.
Mm-hmm. Let me ask you just on the economy part of the equation here. You just kind of mentioned like even the debt to GDP and where it is today. Like it also makes me wonder, Ted, like how much do you think the government has played in the role of like I don't know if I want to say like perceived health of the economy or the state of the economy, even like propping it up, just feels like it's such a big part. Like if you even go and look at like the job side of things, the labor side of things, a lot of the job creations coming from the government spending is a big portion of GDP. I've learned that from my conversations with folks like Eric Bosmasian and others. Just curious, like, how do you think about the government part in the equation of like where we are in the economy, especially if you have something like Doge come on board too?
Well, they brought us here because they unfortunately did not have good advice. And in the last 3 years, in the midst of a good economy, really, they kept on spending money and going into debt well above, what it should have been. And so our deficit kept getting higher and higher and higher. And so what happened with that is, in order to get from that, let's say we're at 6.5%, I think, on the deficit. Let's say they were capable of maybe saving $1 trillion somewhere. I don't know where. Okay. But if they did, that would still put you at a 3% deficit, and those are big numbers. So, and if you go look at that 7 trillion and you look at Medicaid, and Medicare, defense and Social Security, there's just a little bit left over.
Mm-hmm.
So you're going to have to, you get in the middle of all of those others and do some efficiencies. I'm not saying you couldn't do those efficiencies, and you could conceivably keep the benefits just like they are. But on the other side, you're going to be laying people off. You're going to be putting people, this is all government employee type stuff. So, I think you have to brace to a degree a slower economy than what we've seen the last 2 years, just because what happens, and that's where we are. The government has been too active. They spent too much money, and they shouldn't have done it. But, it's all about trying to get reelected, if you want to know.
I kind of wonder, this is just me thinking out loud here. When we're talking about like you can take some pain in the short term for that long-term gain. I wonder if like there is a window or a door here where, Trump's coming into office again. He could make some of these tougher decisions and point to the past administration like Bidenomics and say, well, I'm cleaning up this mess. That's why we're taking this pain now. I wonder if there's a way to spin that. I don't know. Just thinking here.
I don't know. I'm not. I think he's always thinking we got to have good news. We have to have good news.
Stock market's got to go up, right?
Got to go do well.
Yeah.
And I think with everything that's happening, if you look at everybody that's going into these different departments, their number one goal is to revamp it, make it more efficient. Well, when you do that, you get, this is a big boat to have to turn around. And so when you do that, you're going to obviously take some juice out of the economy. And that, I think, is what people should be on the look for. We don't have a problem with lower stock prices, by the way. They get low, we get excited.
Oh, I know. Yeah, you're one of those guys that has the liquidity and the cash, the dry powder. And you've actually historically, if you don't mind, mention this, you've done really well when we've had these like crazy periods. I believe you did really well in 1987, 2003, and then right after the financial crisis, 2009. Is that correct?
Yeah, those were our biggest years.
Yes.
Really. And it was not because we're geniuses, because we're obviously not. But what we did have was we had liquidity. So, because when you have to think about it like this right now, and I just got these numbers from the Federal Reserve, Julia, if you look at, and this was through basically October 1, 24, 79% of all equities, not in the U.S., all equities are owned by people over 55 years old.
Okay.
And then 79. You go and look at, now, and a subset of that is 38% is owned, of all equities now, just a few stocks, every stock is owned by people over 70. And what we've mentioned to so many people is, if you go through a period like 2000 to 2013 or 1965 to 1983, where nobody makes any money, you don't lose a ton, you don't go anywhere. So inflation eats that dollar amount away, and your buying power goes lower and lower and lower. And I'm not certain those people at those ages are ready for a nasty market. I put together a graph last week. It took the last 5 years of the S&P 500, the exact number, total return. And in the sixth year, I said, if you have a 40% sell-off, your compound return goes to 2.8% annual. If you have a 50% sell-off and you're fully invested, it goes to zero.
For all time.
All 6 years.
6 years. Okay, 6 years. Because the average compound is usually like 7 point something percent, according to Professor Jeremy Siegel.
Well, if you're talking about in trying to get to a certain number, what I'm talking about is I took the actual returns. The
actual returns. Okay.
The S&P 500 for the 5 years through 24. And said, well, what if in 25 we get a 40% break or a 50% break? And I know people say, oh, you're crazy. They'll never happen, but they don't know history well enough. It can happen. I would think more likely this year, with all this going on in Washington, that we would have a different kind of market, where we would have 2 or 3 periods where the market really drifts a good bit lower, maybe 20%, 25 points, then goes back up, goes back again. And I have to tell you, the investment community, not us, because we're used to doing this, but by and large, the investment community is not used to or doesn't know the fine art of how to trade something. And that's where I think the money will be made, more than just buy and hold, like it's been, in the last 12 years.
Yeah, that's interesting. Again, like, I love just exploring different scenarios and probabilities here. Okay, so it makes me also wonder too, like, you're mentioning 79% of the equities are owned by folks over the age of 55.
Yeah.
38%.
That's a Federal Reserve.
Federal Reserve number. Yes. Federal Reserve. And the 38% of all equities owned by people over 70. But my question, and I don't know if you know the answer to this, but it also makes me wonder, like, how do they own it? ETFs? Because we've talked a lot about like the passive bid in the markets, and what happens when you start to see selling, especially when you have a lot of this like kind of passive bid.
Well, it's interesting, Julia, you asked that, because in this industry, and I've been at it a long time, but when you get to the tops of these bull markets, you have a lot of people that become the do-it-yourselfers, because it looks easy, and it was easy, and they did well, and they fancy themselves as, I know how to do this game. Well, then you run into one of these long or hard bear markets, and they get flipped upside down, because everything that they thought worked that way didn't work that way. And usually that's where, and Warren Buffett will tell you the number one thing in investing is to control emotions. Control your emotions toward your investments. And when you go through one of those bad periods, if you've been used to nothing but good, it really strains that a lot. And that's why you have a lot of people check out. To answer your question, I would guess a lot of them do have exchange traded funds, index funds. And I usually call it the one button sell, because they just hit one thing and they sell everything. And it's really interesting. But we see it. We have people come in, want to do business with us, and they may be 80 years old with 85 or 90% stock, and we will not take that account because we have a fiduciary responsibility. And I can imagine somebody at 85 years old losing, a third or half of what they have. We don't want to be on the end of that. So there's a lot of changes out there that happen when you go into different kinds of markets, and you could easily have the next 5 or 10 years where the market doesn't, wipe you out like 50 or 60%, but it has these ups and downs, and you get to the end of the period and you look back and say, you know what? I haven't made a dime. It's still the same. That is one of the problems for investing when you're buying the averages and not buying a single company.
Yeah, that's a good lesson too. As someone who's been in markets for well over, I think you have 40 years, right? 40 years of experience.
Well, actually, it's 6 or 7 years longer than that. But
okay, but managing
yeah.
Yes, okay, more than that. I don't know if I don't even know if you even know the answer to this, but how do markets usually do when you have a change in administration? Because it seemed like there's a lot of optimism heading into this. Expect there still is. Is there how do markets usually perform when you start a new administration?
If you look at the presidential 4-year situation, you can track this on markets. Typically the first year into the second year, if you're going to have some trouble, it happens in between those times of what happens, because you have some trouble stirring. If you look at, for example, what I told you about Reagan, where he had a lot of stuff he had to fix. We had that really, really high inflation. Or look at George W. Bush, where when he came into office in I guess it was January or whenever it was after the lawsuit in 2000. Well, didn't realize 18 months later you had 9/11. But even during 2000, the market was already headed down, economy was slowing, rates were going up, and so sometimes they do okay and sometimes they don't. You never know. 2009 when President Obama came in, we had already had the worst was behind us, so you had a good year in 2009. And so it's a setup. Now, right now, though, here's the thing. We're at all-time highs. We're 22 times forward earnings. We don't have, and could we go to 25 or 30 times? Yeah, you could. It would be a screaming sell, even more so than it is now. But you just never know how that transpires because you get a lot of different people coming in.
Do you think markets are too complacent right now?
Oh, yes. Almost everybody is complacent right now. I mean, we don't see nobody we see, and we run quite a bit of money, but we in talking to other people that are thinking about doing business with us or that sort of thing, they don't see any need at all to cut down their stock exposure. None. It's like, and I see this all the time on comments back to us, which is, hey, you know what? You hadn't liked this market for a few years, and we like what we like. I mean, we've got 55% or so, 58% in stocks. The rest of it we have in treasuries. But what I'm trying to say is, when you get a lot of comments back that say, hey, don't worry about it. It'll fall off here in the short term. We'll be back at new highs in 6 months. Be back at new highs in 3 months. And here's why. COVID was a 5-week bear market, 5 weeks. And then you get into 22 and it was a 9.5 month bear market. You go back to new highs. See, it's a drug. Mm-hmm. When you take it, it's like, I know we always go back to new highs. Well, sometimes you don't go back to new highs. I mean, you went from, oddly enough, 1929 to late 40s. I mean, he went all the way in the early 50s where he really made any money. And so people get confused on that sometimes. Depends on what's happening in the whole world.
Mm-hmm. Okay, so you do have stock exposure, 55% in stocks, the rest in treasuries. We were talking about at the top of this, like the market's really been driven by a handful of names, like that. Those kind of like group, like 10 names.
Yeah.
Are you in those names, or are you trying to look for like more value names? Where are you kind of finding opportunities, or have you been finding opportunities?
Well, that's a good point. If you look at Microsoft, is the oldest holding we have, 20 years.
Oh, wow.
And,
yeah.
And so what happens is those kinds of companies get expensive. And if you look at those legacy stocks that we still have, like Alphabet, Google, Microsoft, a little bit of Apple, I think their best days are past, but those are real low cost basis for us. So we just keep taking them down, and we don't buy those for new money. And what we find now is that it's interesting. We see the market shifting to more stable type companies, if that makes sense, like dividend payers, stability. And we sense that as what's happening here. And they're getting away from, that Big 10 stocks. Again, almost every one of those Big 10 peaked in the first week of December 24. They're not at a new high. You'll have market days like today and yesterday, where the market's up, Dow's up 400 points or something. People think, man, we're having a good market day. Well, you're really not. You're not back. You're not back to where you were on those stocks in December. So we're seeing a subtle shift toward more stable type companies that have dividends, pretty solid growth. They all go down, by the way, in a bad bear market. So we're not fooling ourselves, but companies are good buys. And so we'll buy a piece of them, for example.
Yeah. Are we just seeing like the move today in the markets? Because again, it's Friday for the folks watching this. The markets close in less than half an hour from this conversation. But is it just Trump optimism there? Why we've seen today? I to be honest, I had not been watching like all the movements or anything. But is that just because we're starting a new administration?
It's probably a couple things. It's probably the Israeli Hamas.
Oh, that too. Yeah.
That's one.
Yeah.
But the other thing is what you're saying. I think people I'm so glad because we're going to get in front of this thing because I know he's going to do so many great things that I want to own him before he does.
Mm-hmm.
Well, that's a wait and see thing. You don't know that. And I think that's why people, I've always found if you chase any market, you chase up or down, will always get you in trouble.
Mm-hmm.
And so we don't do much chasing at all. But I think that both of those things are part of the reason you're seeing the market perk up yesterday and today.
Mm-hmm. Do you ever watch Bitcoin or pay much attention to Bitcoin?
Yeah, I watch it. Sure. Yeah, I see what the price is. I look I look at other coins. I'm always curious at what's going on in that marketplace. Yes, I do.
Do you have any point of view on it, or?
Well, I think here's the thing about Bitcoin. It's not a huge float. I mean, you have a few players control a lot of Bitcoin, and a lot of the Bitcoin holders that I see, this is empirical knowledge only, the people I talk to, but it seems like a lot of younger people have small pieces of Bitcoin. And if somebody asks me about Bitcoin and I have a chance to buy a company that will pay us a great dividend and pay as free cash flow, it's got a great brand that I can hold for the next 10 years and buy Bitcoin, I'm going to buy the company. Nothing against Bitcoin, by the way, but I think Bitcoin is a speculative item. And people say, well, no, it's a decentralized currency. Well, it's not, because it goes down too much when the markets go. It goes with the stock market. So you're not going to correlate a currency to the stock market. But you let the market fall 20%, and I can just about tell you for sure, Bitcoin will go right with it. And they've dropped a couple of times over 60%. And all I tell people, hey, we get that question quite a bit, is that, look, realize what you're doing. You're speculating because you have to find a buyer more than you pay for it. That's your only way out here. Okay. If you know that and you're speculating, that's fine, because I don't think speculating is bad. It says you got to know what you're doing, and don't look at Bitcoin as quote unquote an investment that you want to, I think, hold on for 10 years, because I think there'll be a lot of ups and downs in it.
Mm-hmm. How about a topic that's really popular on this channel, Ted, is gold. What's your take on gold these days?
Well, in all three strategies, we own two strategies. We own gold and the miners. One strategy, we just own the miners. That's in a stock strategy. So we like them, on a cash flow basis. All the miners are selling at cheap cash flow multiples. And now we've been in this group here for, 2 years, so it's not something new for us. And two of the strategies we have about 4% in the bullion. So we like it. I think, again, if you look at foreign governments, they're tired of putting all of their money in the dollar and in the treasury. So they're cutting that out and they're buying gold. All of a sudden, not our market doesn't, central market, but theirs does. And that's where a lot of demand has come from. So I think you should probably, and I would look at gold as a side-by-side semi-currency relative to currencies, because a lot of countries want to back their currency with hard asset like a gold or something along that line. But we like gold. I think you have to temper what you own. We're not going to have a whole gold portfolio, but we own some. The miner's cheap, though, as a company. All you have to do is go look at the cash flows.
Yeah. Okay. So when I think about 2025, a topic that's come up on this show, Ted, the Federal Reserve. So when they had their FOMC meeting in December, they're signaling 2 rate cuts this year. What is your take on the Fed in 2025, and maybe more of your outlook on rates?
Well, I have to say I don't have a clue as to what they're going to do, because I'm not certain they have a clue as to what they're going to do. And the problem with that is they'll tell you we're not a political animal. But if you notice what happened as soon as the President Trump got elected, and this whole situation, they started talking down the fact that they may not have any more cuts. They switch around a lot, and I think there's an arrogance about them. But I think this is where they're going to hit the wall here. Is they're up between a rock and a hard place here. If they lower rate, I think either way, the 30-year bond price goes down and the yield goes up. Either whether lower or raise. Here's why: if they lower rates, which they should not be doing now with this type of economy we have, you automatically push the money in, you automatically have more inflation. That hurts the bond market. If they raise rates, if they raise rates, then you're getting in a situation to where you put pressure on the foreigners to sell bonds, because that raising those rates would be to keep the dollar going, see? And then they're like, "Hey, I don't want any more of this. I'm going to take some of this debt down." And the way they would do it is sell treasuries and pay down to not dollar denominated. I think they're caught either way, and I think that's what would really throw this Federal Reserve.
That is a tricky spot. Yeah.
I don't think they realize. I think they think, "Hey, we've got this under control. We've told you we got it all under control," but they don't have it.
Yeah, that could go. Yeah, go either way. You can run into some tricky spots there.
I'm sure the Treasury's going to work with them to a degree, because there's just too much debt coming due. They've got to go. You've got to go to the Treasury markets big this year. Mm-hmm. I mean, you've got if you look at almost half that 37 trillion or 36.5 trillion you mentioned, almost half of it comes due 15 in the first 2 years, 25 and 26. So you got to sell those bonds to somebody.
When you look at our debt situation, do you see a way out?
Yeah. I think the way out, and I think they'll try to probably do this, is in the long run. I think we'll do something like Japan, where you may not call it, interest rate, control, but it'll look something like that, where they'll keep the interest rates lower than inflation rate. You'll do that for 15 years, and your debt to GDP will be a lot lower than it is now. But your buying power will be horrible. Yeah,
what would that mean? What would that mean for like everyday folks if they went that way? What would that mean?
Well, they would keep buying CDs and they keep buying bonds, and what they would forget, and they would get a rate of return on them. It'd be low. Let's say inflation is 4.5, and they're getting 3 points or 2.5 points on interest, okay, which is a lot better than it was when it was a quarter. But if you sit there and you do that for 10 years, you can see what's happening. When you get ready to use that money in the buying power mode, it's worth less because inflation's running higher on everything that you buy. And so even though you're not losing any money, you're really not, because you're in the treasury bills or the notes and they pay off and you do fine, but the rate's too low, relative inflation. And somewhere in here, probably, I'll be surprised if the Fed doesn't come back and say, hey, we can't do this 2% thing. It's going to have to be 3 or 3.5 or something. And so that is how you get out of it. You can be austere and get out of it, Julia, but the problem is you'll have a depression. I mean, if you want to write your expenses, if somebody just said, okay, I got one person in the world is got a debt problem, I'll just look at them as a consumer, the federal government as a consumer, they're a person. Well, they're upside down. they can't do anything. And so, they have credit card delinquencies, and so to speak, but that's how you get out of it, though. You inflate higher than the interest rate.
Yeah. Well, and I imagine if we had to go that route too, like if we had to inflate higher than the rate, we would all feel that too, like just everyday normal folks, wouldn't we?
Yeah, you would feel it. And a lot of pricing. I do think sometimes wages would go up, though, with it, because when you get in these periods,
that too,
they tend to adjust. But if you go back and look at your history, go back to the end of World War II for the next 15 years, and you'll see that's basically what happened. When Reagan came into office, it had gone better and better, and it was down to, I think, 30%, maybe 33, 34. And so they had a lot of room to do things.
Yeah.
We don't have any room now.
That's the important distinction. Yeah. Yeah, the room to do things. Okay. When I was listening to you earlier at the top of the conversation on the economy, I was kind of sensing that maybe, and I do not want to put any words in your mouth, do you think that we're likely to see a recession anytime soon? Or why haven't we seen one either? But just kind of curious more of your economic outlook.
Julia, it go like this. If you take the bullet points of what they want to do coming in this administration, okay, if they just take off after it and start doing it, and it sounds like they're going to run a lot of, pitch a lot of things out and let people see what's happening. If they just take off after it without any adjustment in the dollar or anything like that, then what's going to happen is, and you just run the numbers, if you take $1 trillion out of the spending side, which is what they would do, they want $2 trillion. But if they take $1 trillion out, they get your deficit down from 2 to 1. All right. But that $1 trillion that comes out, they assume it's like somewhere over 2 points, maybe 2.5 points of GDP. Well, if they took $2 trillion out, to me, you're automatic recession. Because that's a lot.
The math, yeah.
You had a balanced budget, but you have some trouble out in paradise.
Yeah. And then the implications and the effects of that probably impacting the stock market as well. But like you said earlier, you're one of these guys, you have the dry powder, the liquidity, you've noticed the complacency out there. Maybe contextualize for us, because you have been able to do well when we've had turbulent years because you've been prepared with that liquidity. Some folks find themselves without it, which would be a real bummer too if that happened. When you look back over your career, like, do you have more liquidity than you usually would, or would you contextualize that maybe, I don't know, maybe it's just kind of the standard procedure, or do you get more worried?
Well, no, we have about the same amount we had in 2008 and same amount we had in the first quarter of 2000. About the same percentage. We may have been a little less than 2008, probably were. I think we were like 40-something%, and should have been 65 or 70, because they kept on coming down. But we don't have a lot of periods where we get this liquid, and really the markets, this whole money thing that juiced these markets over this 14-year period, that's the abnormal part of this whole thing. If you look at another 150 years of market history, that's abnormal. What's normal is a lot of ups and downs, rates going up, coming off, higher rates of interest. If you look at the 10-year U.S. bond, since 1979, 49% of the time it's been over 5%. So we think that's just horrible. It's getting up to 5, but if you go look at history, it's been a lot of time over 5. And I think that's what will happen in here. You're just going through a shift in people's mindset. It will eventually shift, but it takes them a long time to get there.
Mm-hmm. So, what would happen if it were over 5%? What would be the implications?
I don't think a lot would happen. I mean, you wouldn't change. I don't think you'd change anything going on in the housing market because, existing home sales are non-existent in a way.
That's so true.
Yeah, and really you would have the problem you'd have is people would be getting more interest, but the higher those rates go, the market suffers. Mm. So they might get it on one side or the interest.
That's an interesting dynamic. Yeah. Huh. Oh, yeah. You're getting at a sore spot on the housing bit. As someone who's so frustrated by housing right now, it's just brutal.
Well, you have to. If I were a young person, you have to buy a new house.
Yeah,
right? Because the builder will buy down the rate. Now, on an existing home, that doesn't happen. If you're a builder building and selling, most of those builders are buying down the rate.
I know. I just love how they're growing. I love like the charm of like the older houses. It's so bad but I mean, just like I run almost every morning to like my dream neighborhood and stuff and look at these beautiful homes. I'm like, but yeah, it's crazy. Yeah. Okay. The new is the way to go these days. Okay, so you are a prolific writer. You have several books. Your most recent, Stay Rich with a Balanced Portfolio, but you're working on a new one, or is the new one out yet? I know you have one coming.
It's interesting. It's finished.
Oh, is it available?
It'll be available. What's today? It'll be available the last week in February, I believe. It's in the printer. We'll see. The title is Second Generation Wealth. What do you really want for your kids? So we'll see. We'll see what people think about it. Yeah.
Oh, well, I love your books, and they get right to the point. Sometimes I feel like some books are just way too long, but I like yours because they just get to the point. No wasted pages, no wasted words. So that will be an interesting one. I know we've talked about that because I feel like that's such an interesting conversation too, just like the generational wealth and how do you keep people motivated and productive, and so they don't just like sit around just because they have money?
Well, that's what we talk about in the book. There's some people that I've known have done it. I just point out in the book what's really worked and what hasn't worked, and you have to really put some time. If you let's say, I've said this before, you sell a company today for $50 million, $75 million, whatever, and you can do about anything you want to do, really. And I think what people do is all of a sudden they start acting wealthy if they've got kids at home still and all that sort of thing. They probably don't want to do that. They need to go on life as usual. And it's a hard thing to do, but you have to put the time in to say, okay, this is the way. I have a lot of money, but this is the way I'm going to raise my children, as if they'll be comfortable, but they're not going to know even close to what kind of money we have. And by doing that, you make them normal. In other words, they have to work during the summers. They have to pay their own insurance on the car. Mm-hmm. They can't buy a brand new BMW. They get some beat up, 4Runner. It's 11 years old. You do things like that because then they understand that, hey, I've got to fly to meet my parents somewhere, but I have to fly on Southwest. Mm-hmm. I got to go through TSA. I know the parent sends, like I've used this before, but they send 10 kids down to Cabo at spring break on a Gulfstream. I'm like, no, it's not going to work. Yeah. I mean, if what you're trying to produce, maybe you're not, but if you're a parent trying to produce a child that has a great self-esteem stands on their own 2 feet and know they can make it, whether you have money or not, then you produced and put a wonderful person into society. If you put a person just waiting for you to die so they can get the money, then you've done nothing.
No, that's the worst. That would not be ideal. Ugh.
Yeah.
This was an interesting, I don't know, maybe I told you the last time we talked. I'll keep it totally anonymous, but let's say a billionaire, for the kids, they just matched their salary. So they had to like work actual jobs. And so it was just dollar for dollar match the salary, which was kind of an interesting take.
Well, that's okay.
Versus giving them millions and millions of dollars. It's like, okay, I'll just match your salary. So it depends on the job that you go and pursue and get.
And really, I think there's nothing wrong with that. I mean, you're just giving them an incentive to work, which is what you want them to do. You want them to work. People don't realize, but what makes a person as far as strong for the future is adversity. If you never have any adversity in your life, you're not going to be a person that people want to lean on because you've never had it tough.
Yeah.
And it's a problem. And then if you raise a child like that and they have children, the third generation will be worse.
You know, Ted, we've talked about your background. You grew up in poverty in rural Georgia, and you've talked openly about that, and we have had past conversations. You're someone who's attained success. Like, how did, like, with you, like raising children, like how do you kind of navigate these things? If there's anything you can share there, but just curious, like.
Oh yeah, sure. Yeah. I grew up on the North Carolina, Georgia border. We were true hillbillies. I mean, we didn't have anything, and never did have anything my whole life, really. But what happened was when I raised a family and I became more successful than I thought I would be at that young age of having kids, I didn't forget these things, which was, even though my parents didn't have anything, they had tremendous work ethic. And all 5 kids had to work and work hard. All of us had outside jobs somewhere else. We bought our own clothes. We did all of that. And so you teach that through the parent. And I just, I started when my kids were 13, when they both turned teens, or the girl and a boy. And for the next 3 years, so they got to be 16, I went to people I knew that owned companies. And I said, I'm going to give you enough cash here to pay them cash every Friday, just like anybody else working here. They're not going to know that they're not really an employee. And they did it for me. And then when they turned 16, they had to get their own job.
Yeah.
And then I had work between college semesters in the summer. I mean, all these other kids are going to Europe and going out, hanging out at the country club, laying by the pool, and mine, that's not happening. You got to get a job. And then, you know what, if you make a lot of money and you want to travel, go travel.
Yeah. I don't know. I feel like it's a patriotic thing to do, is to like contribute and work, even if you had tons and tons of money, but like to contribute to the economy. And maybe that's just my weird view, but that's how I kind of feel about it. It's like, if you're able and willing and you can be productive, why not?
Well, I can't tell you the number of times this has happened to me with people with really a lot of money. And I've had them tell me, people 55, 60 years old, say, I wish I had something. I don't have any purpose in life. I can get anything I want, but I don't have any purpose. And I feel sorry for them because they don't have any responsibilities sort of to themselves. They could go, I always tell them, hey, you can go do another job, or, just so you did something, or do charity or whatever. But they don't do that. And so they just really mentally dwindle. And that's not where you want to be.
No, certainly not. I have to say, Ted, we love having you on the show. It is always a treat. I want to leave you with the final few minutes here. Let folks know where they can pick up your books. If there's anything that you want to say about the work that you do at Oxbow Advisors, and any parting thoughts for this audience, the floor is all yours.
Well, thank you, Julia. As always, you have a great way with people. I appreciate that. At oxbowadvisors.com, you can see everything. If you want, you can come there. You'll see we have, I think, 10 books on there, and then this will be the 11th. It should be out for sure by March 1st. It's all done. It's all finished. I think anybody that has a lot of money and you're worried about your children, I think you'll find an interesting read in terms of things that have worked and don't work. And in the very last part of that book says, hey, look, I don't care how much you do, how good you plan this system, you have to remember they are their own person. And if it's not working out, you can't take that guilt trip with you the rest of your life if you did what you should have done. And I always try to leave them with that note that, you know, you'll probably be okay, but it might not. You might have the kind of kid that just is, it's just not going to work. And that's one of the things. The second thing I would leave with people is, you know, really think about having enough liquidity so that if you have to wait through a couple of years or 3 or 4 years of a market that really doesn't do too much, that you feel good, you're okay with it, and don't try to beat the S&P by 1 more or 2 more notches and have more NVIDIA than somebody else or something along that line. Think about your overall picture, and I think you'll be happier.
Ted Oakley, founder and managing partner of Oxbow Advisors. Thank you so much for being so generous with your time, all of your knowledge, your wisdom, your ideas, and just for being a friend of this show. We love having you on. You are always, always, always welcome on this program. Anytime. We want to get you on as much as we can. So thank you again, Ted. Really appreciate you.
Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.